There's so much that's going on in this big conversation about what's happening with the Delta variant. Certainly it rattled the markets early in the week, but we ended up on a positive note.
Right. At one time on Monday, we were down 900 points on the Dow, and I never would have thought at that time that by the end of the week we would have surpassed the 4,400 mark on the S&P 500 and the 35,000 mark on the Dow for the first time in history.
Yeah, that's right. Rallying despite these concerns, and you have to say, even though we are having a mini correction, we have seen these rolling corrections go through the market for several months now.
Yeah, it really has. It's been a challenging environment for stock pickers because the tech names that actually led the market last year as we recovered from the pandemic lows really languished for a good chunk of this year and were replaced in leadership by reflation trades. By that I mean companies that are more cyclically oriented, that are going to do better as the economy reopens, that had gotten too statistically cheap. So we saw a rotation from those growth stocks to value stocks. And unless you're a very nimble trader, it really just demonstrates the need and benefits of a more balanced portfolio that isn't too tilted one way or the other, but just looks opportunistically within growth and value sectors.
Now, the fact about corrections is they are common. In fact, having a correction that means more than a 10% peak to trough is very common. We see it on average about every 18 months, and we've gone almost 18 months and we haven't seen it. But by the way, that's the definition of a correction. The average correction is about 14% peak to trough. So we counsel our clients and our listeners here today that this is a possibility, but we have been seeing these in sectors across the last several months. This could continue to happen on the indexes, which we haven't seen.
Right, and most recently, the sector that's been under the most pressure are small cap stocks. Sometimes when people are uncomfortable about the growth rate in the economy or they're concerned about the Delta variant, they'll go for safer companies, the larger cap, mega cap companies that they believe are going to hold up okay in the event of some weakness down the road. But as you mentioned, we haven't seen a correction since the lows in March of 2020. And of course, it could happen at any time. But ultimately, markets are driven by three things: liquidity, sentiment, and earnings. And right now, this market checks most of those boxes.
Exactly. You can't doubt that there is an enormous amount of liquidity. But the second part of that is earnings. And earnings are starting to come out, and they are doing great.
Earnings have been fantastic. 80% beat rates on earnings and revenues. Also, more importantly, the guidance. 15% of the companies that have reported so far in the S&P 500 have announced positive guidance, which means analyst estimates remain too low and have to go higher, which ultimately leads the market to a more reasonable valuation by virtue of growing the E in the PE ratio.
Yeah, that's right. So when you have bigger earnings, they have more value in your pricing as well. So the P to the E, the price to the earnings, is what Derek is talking about. All the reason more. If you're listening to this right now and you want to know if your risk is aligned with the potential return, there is a way to look inside your portfolio to understand it. We do this. We give this away on a daily basis.